Okay, so I want to thank everyone again for showing up today. This is part of our virtual town hall series with Washingtonians for Public Banking, which is a series that we organize that covers issues related to public banking or finance. We have a really good presenter for today. His name is Yakov Feygin, and he is the Director of Public Finance at the Center for Public Enterprise. He works with municipalities, activists, advocates, and states on green and public banking, as well as public energy development projects. So without further ado, you could take it over, Yako. And do you need me to share duties with you so you're able to uh, uh, put up your PowerPoint?
Let me just, yeah, I think I'm actually let me see if I can just share my screen, or not. Okay, now I'm the co-host. Perfect. Thank you. Okay, give me 1 second. Uh, your screen. 1 second. Okay. All right, can you just, sorry, give me 1 second to just
So,
get
okay.
um, well, while I'm getting my kinks out, because I haven't used Zoom in a while actually to share a screen. Um, I just wanted to kind of elaborate a little bit on what it is the Center for Public Enterprise is and what we do. And that'll I think set up the presentation quite nicely that I wanted to give. So the Center for Public Enterprise, we are a think tank and we provide technical assistance on establishing public financing and most importantly, public development projects and policies. We mostly work with states and municipalities, but also on the federal level. We work in two areas right now, though we will be expanding, which are energy and housing. And I mostly work on energy, frankly, though we also do some housing work. I'm also involved in the housing work a bit. And we came into being in part as the Inflation Reduction Act was being passed. And we began to realize just all the goodies and possibilities for public finance in that bill that I think aren't well appreciated outside very specific circles. I came from a green banking, well, initially a private banking, public banking background. I've consulted to public banks before. And what I want to talk to this group about is what, given IRA, is the future of public banking? Where are these opportunities? And what do we even mean by public or green banking? And what the trade-offs are now that we have some opportunities. This presentation is a bit ad hoc, but it's going to be in three parts. One, I want to cover the theory of banking, right? What banking is, what it might not be, right? Or because it's a rather ambiguous term. Then I want to go through some specifics of what is in IRA, and where IRA enables green banks, and what are the little obstacles. And the third part I'm going to bring in, and I'm going to go through a model project that we're beginning to kind of shop around the green banking community and through some of our partners in the federal level, the Department of Energy, and we're trying to think through with them. And I'm going to close by kind of bringing it all together and saying, is this public banking? Is this what we want? And what is really going on here and where the opportunities in the future might be. So without further ado, everyone see my screen, I assume. Um, you know, I want to get into what we mean when we mean banking and when we talk about public banking, because banking is several things. And, there are some historians, there's a very famous 2001 paper that argued that, banking as we know it is actually a historical accident. That there is no reason that we use the same institutions to both create credit in the economy, so issue loans, and enable payments in the economy, so create deposits. This is actually a very long-running criticism of banking, kind of a piece of a horseshoe, where there are people on the left and the right might agree that you might want some narrow banks, right? There was even a plan during the New Deal era that had both progressive and libertarian actually backing for making all banks narrow banks, right? And not allowing them to invest their assets and making all banks either 100% reserve bank backed deposit takers for you to put your money into and pay for things, or investment banks where they would just be the Wild West, right? And you would be taking risk with them. And that's famous Chicago plan. I frankly don't think that why we do investment, credit creation, and payment enablement through one set of institutions or through a network of institutions, as we'll see, is a historical accident. I think systems tend to do what they do best and serve the purpose they exist to by their function. And I think that's really important to keep in mind as we kind of break out where and what we can do in public banking, where the limits are, and what our opportunities are. So the way I always describe this issue is that payments create credit, and credit creates payments. Because in creating payments through a banking system, there is always an expansion of credits. And for credit to be usable between two entities in the real economy, there always needs to be a system of payments. And bundling them together one way or another is rather convenient and efficient. And I will use a toy example, but it's a useful toy example that I always use when I taught money in banking and generally talk about it. And it's a transaction between Digcore, whose job is to dig holes, and Shovel Corporation, whose job is to sell shovels. Dig Corporation really needs to dig a hole. It believes it'll make a lot of money by digging holes. Dig holes, it needs a shovel. And it does not have money right now to buy shovels with from this shovel company. The good news is Dig Corporation is a client of a bank. And the bank thinks that for one reason or another, digging holes is going to make a lot of money. Maybe they're believers in advanced geothermal. I certainly am. So it issues a loan to the Dig Corporation. The loan is an asset, right? It's earning interest. The bank also has deposits. That's really important. It has people like you and me or whatever customers it has that have entrusted it with maintaining a balance sheet entry for its money. So what's going to happen? What happens when Bank A decides to give a loan to the Dig Corporation? It actually opens up a deposit on its balance book in the name of the Dig Corporation. And if the Dig Corporation and the Shovel Corporation actually share the same bank, well, it doesn't really need to do much. It just transfers purchasing power on its own balance sheet from the Dig Corporation to the Shovel Corporation. And in making that payment, it's created credit. But in our world, it's a little more complicated, and the Shovel Corporation does not share a bank with the Digging Corporation or the Dig Corporation here. I don't really know the extent of this group, so maybe this is all had. Everyone knows this about banking, but let's just say this. Well, the Dig Corporation, well, then the Shovel Corporation, using whatever interbank clearing system they have, transfers the deposit to Bank B, which is the Shovel Corporation's bank, when the Dig Corporation goes ahead and buys a shovel from them. So takes out the shovel, and the new Shovel Corporation now has a new asset, which is the deposit on Bank B's books. In this world, we're just going to assume this is a purely Fed funds market world. So here, something new comes out. These are called reserves. Reserves are basically tokens, right? They're legally created tokens in a central bank. That banks will then net what they owe to each other every day and clear at the end of the day. So in order for this transfer to occur, Bank A has transferred some reserves to Bank B, right? They've netted, and now Bank A owes Bank B reserves. And Bank B now has excess reserves, more than it needs to back its deposits legally. So it can make a little money. Bank A needs more reserves now in order to cover its ability to service its deposits. So it's made it now, decides and goes ahead and makes a loan to Bank A. And as you see, credit has been created, real economic activity has been created through these balance sheet transactions, and payments have been facilitated, and the system has more or less balanced. It's gone on because everyone's going to pay their loans. So these are, your standard like kind of story when we talk about banking. That's not how the real world always works, right? In the real world, you have other bank entities that aren't deposit takers necessarily. You can have investment banks, which are more regulated, so they're usually using bond market finance or various other capital market financing instead of deposits to fund their assets. Or you'll have shadow banks, which are, even less bank-like to the way we look at. They might be hedge funds. They might be just broker dealers, which are using what we would call wholesale money market borrowing, things like treasury repo, things like borrowing in the offshore LIBOR market to fund their assets. And frankly, that's actually the majority of how credits are done and operated is through one of these two. Like your retail bank doesn't actually give out that many loans, though it probably will through its shadow banking and investment bank arms, but there's very regulated relationships between them. But they will still need somewhere the retail banking system to work. So what I've just done is I've added an investment in shadow bank that has decided to dig into DigCore, invest into DigCore. And that we'll call that Bank A. And I've made Bank B that's still DigCore's business bank. So that's where they're running their day-to-day payments from. And then there's Bank C, right, which is operating both as a dealer and also the shadow banks or the investment banks. We won't really care about distinction for, this little like schema here. Trust me, it'll all make sense. I am getting to something here. That's going to be, its bank. It's probably like a branch of it that's just regulatorily set up separately that processes the payments for them, right? So there is still a payment and the only system here. And the only difference here between what happened before and when we have a non-retail bank involved is the shadow bank or the investment bank is creating a loan to the DigCore. And then it goes to its payment system intermediary, which is going to be Bank C. It draws down its deposits now in the name of DigCore when DigCore wants to buy a shovel from Shovelcore. And that Bank C now will transfer its reserves and deposits to Bank B in the name of the shadow bank. Much like this situation before, right? Bank B now has excess reserves. It can make more loans now. It has more assets to go up to expand its book with. And guess what? It's going to invest, right now, we'll say it's, a classic investment bank, is going to invest in Bank A's bonds. Now, what's all really important is right now in all of this, there are two things that line up. One thing that lines up is that everyone can make their payments, right? DigCore is going to make its money eventually and pay back its loan. So all of this credit that's been created is going to be paid back by hard money. It's going to be paid back by earnings that are cash or cash-like. So it'll be someone else's deposit now paying for DigCore, or or somewhere this bank is going to have somewhere someone's going to have a failed loan and they're going to have to borrow cash-like instruments somewhere else to cover it. In our modern world, those are government liabilities or near government liabilities, right? And if you can't get those, then you have a problem. Then you're going bankrupt, right? Then you're going to have a run. Then you can't make your depositors whole. You can't make your borrowers whole. Then you have a problem, right? That's a classic bank. The other thing here that I kind of want to underline is that we're operating in a system with a central bank here. There are reserves, and reserves are high-powered government money. These are what we call outside money. So they're money that is not credit. These are interbank loans to one another that are administered by the Federal Reserve. There's no liabilities. There are no assets backing these. This is a modern system. Some would say this is a modern money system. So there is a trade-off here, a policy trade-off that my colleague and co-author Salia Marova has called almost a franchising effect, right? Where we essentially give you the right to issue state-like money and give you insurance to the private banking system. In exchange, the private banking system commits to levels of regulation and licensing to make sure it doesn't overextend its credit and needs to be bailed out all the time. That's the balancing act of financial regulation. Why does this matter to public banking advocates? Is because, and oftentimes the payment and credit functions of banks can step on one another, as we've seen in the instability of those balance sheets, right? If there is a failure to a loan. And private banks and public banks, if they are non-sovereigns, right? If they are not kind of coming out of the direct fiscal arm of the federal government, are subject to both. And in practice, they're subject to regulation. And we're always making a trade-off within the way we've set up regulation between the ability to offer low-cost deposits and the ability to maximize investment. That's a trade-off you have to make when you're designing your bank. Here is a story of one of these trade-offs, right? That any public bank that's issued under any system, and I've worked in California a lot, so we're working under AB 857, will have to work under. These are standard bank regulatory mechanisms we have to keep banks from overextending credit. And sometimes they work and sometimes they don't. And they have, consequences that I'm going to get into. Let's talk, there is something called Basel III. So the Basel system is one in which a lot of central bankers got together, and they've had 3 of these since 1990, really, iteratively kind of getting new ways, and to create certain standards, right, for national banking regulation. And the point of these regulations is to keep banks from going under, because these are vital utilities for payment and credit creation that are authorized by the state to do functions that the state could do directly. And there are good reasons perhaps we let them do this. There's credit, all kinds of theories as to why we let banks do this, right? They may be better at competition for creating credit and payments, may create efficiencies, or it may not. I'll leave that up to the imagination, right? I'm not going to take a stance on that. But to keep them from going under, there are these accounting rules. And these accounting rules are designed to protect the liability side, which are the depositors, which are also the banks, which are mostly depositors, so bondholders, whatever. It requires your assets to look a certain way if you're a bank, right? It means you have to have a certain percentage of tier 1 capital. That's your equity, right? Like that's literally like stockholders' equity as a ratio, for example, to your total exposure, which is your exposure to these things at the bottom here, which are your loans, which are weighted in different categories of risk, right? It requires, for example, liquidity coverage ratio, which is a difficult model, but essentially it requires you to hold high quality liquid assets that usually is various tiers of sovereign bonds, usually US treasuries or agencies. um, that can be sold relatively quickly. They look like cash, right? And that liquidity of those assets has to be enough to cover your statistical net liquidity outflows, what your kind of historical outflow is over 30 days, right? So you will model that, your possibility of people demanding money back from you. And all of that takes up balance sheet space, right? It takes that attempt to build safety for depositors, for maintaining the ability to make payments, limits in some way the ability to make loans, especially high risk loans. And this has real world consequences. I will tell you, it has consequences for how difficult it is now to get a bank license if you're not a major bank. It's virtually impossible right now to establish a bank de novo, because regulations are really stringent right now. And FDIC does not want to issue new bank licenses. This is just something we know now. I've known from kind of talking to regulators over the years for public banks. It is going to be very difficult to establish a public bank de novo. And it's just as difficult to establish an existing bank de novo. There are ways around that. You probably are going to need to buy out an existing banking license in order to be a real, like a deposit taking bank. It has consequences for the way we do finance for climate, right? The reason I have tax equity as a question mark here is right now we're going through what's called the Basel III endgame, in which Federal Reserve and the Office of Controller of Currency are trying to essentially finalize rulemaking that began really in 2008 to be fully compliant with the Basel standards. What that's done, and I'll explain how tax equity financing works in a second because it's kind of important to the IRA story. But under the proposed rules, they are now going to risk weight, right? So the weight of risk on these loans to prevent the deposits from being threatened. They're going to do tax equity transactions. I'll go through that in a second. And the same risk weight as venture capital, which is, I think, 300% of the loan value is you have to be covered at 300% of the loan's values for capital under for example, liquidity coverage ratio or some of the tier one capital. And tax equity finance is how we finance practically all renewable energy in the United States. It's an extremely powerful instrument, but adding that much risk to it might make it take some balance sheet space and it might dry up that market. Banks won't be able to make it anymore. Now, that may not be the worst thing in the world, but there are instruments that maybe let us get around it that I can talk about, and I will talk about at least one of them. But that's the trade-off, right? And that's the trade-off: safety in your credit ability to create credit versus your ability to administer the payment system through the deposit taking function. And that's something I tell advocates all the time, and I tell policymakers, you have to find that balance. Do you want to reduce the cost of credit to certain strategic sectors or certain groups, or do you want to reduce the cost of payments, right? Each of these aren't necessarily aligned, and that's an optimization as a policy tool you have to make, which gets us into kind of why we've gone down the road more towards green banking and separating out that function from the deposit taking function. And so I will walk you through what green banking is, what it could be, why it differs from public banking, maybe why we can bring them back together eventually. So I want to go through kind of green banking the US before IRA. This is where IRA comes in and was tax equity comes in. Green banks got started as tools to essentially create credit through leverage in order to lower the cost of credit. The transaction I've mapped out here is actually based on probably like the most typical green banking transaction, which was pioneered in Connecticut. by the Green Bank of Connecticut. It's kind of, I think, the first green bank in the U.S. and certainly the largest now. It was founded using I believe it receives revenues from the tax from a carbon tax-like instrument. That's its funding base, right? That's where its equity comes from. And what it does with that equity is it tries to essentially lower the cost of renewables, especially distributed energy resources for LMI communities by lowering the cost of credit. Again, this is before IRA, and we'll talk about how this has changed and frankly has gotten much easier and better after IRA and why this is really important. What it does traditionally is it founds a LLC, right? Just a holding corporation, usually in Delaware, like any other bank. And it uses its money that it receives from this tax thing as its financing to both own the equity of the LLC and to stuff the LLC full of mezzanine debt. What is mezzanine debt? That is debt that has a lower priority, so it gets paid off before the rest of the capital, the project's debt, right? So what that does is it de-risks it de-risks the loans for co-investors. It also does something else, right? It uses, because it enables entities that usually can't get tax credits, including of itself, to use tax credits. Because before IRA, tax credits could only be used if you had a tax bill. And as a government entity or as a nonprofit entity, you didn't have a tax bill. And often as a like low-income homeowner, your tax bill is usually too small for the tax credits you get from from renewable energy tax credits to be useful to you. So the way it does that is it finds co-investors who aren't just interested in the de-risk returns, but are interested in using tax credits. And this is actually fairly common in project finance around energy. We get something called, for example, we have the investment tax credit, which gives you 30% back on your 30% back for developing your solar project and the value of the solar project in your against your tax bill, right? So my solar project costs $100. I can write off 30% of that investment once the project is completed against my tax bill. A developer, a green bank, they don't have large tax bills or they don't have them at all. But you know who does have large tax bills and has lots of money to spare? Large banks do. And then what? So I, as a green bank or even a developer, will go to a large bank and say, hey, let's set up an LLC structure in which you get to take the tax credits and assign it to your tax bill. Then you take your depositor's money and give it to me at a discount rate, like any other loan. So you will make a little bit of a spread in the taxes you avoid paying to the IRS. So that's money you're not giving back to the government that you've created. You will earn more in that than you will give me money, but I need money right now. I need money right now to start my project, right? I need bridge financing. I need construction financing. So that's more worth it to me right now than my tax credits will be in the future, especially since maybe my taxes aren't that high or they're non-existent. So that's another source of capital that they've crowded into this LLC. And then they use the capital in the LLC to write loans that will, fund a nonprofit developer who will, using their lower cost of capital, install, solar panels on the rooftop of LMI household. They'll do it usually using a rooftop power purchase agreement, which means there's no upfront costs to the household. It just means that you are going to buy electricity from me, the developer, from your own solar panels instead of the utility. So you save some money, ideally, though in practice, sometimes it all evens out. You don't save that much. And that savings you're going to get, the spread is how the loan is repaid, right? Out of these like and these rate payments you're getting, the nonprofit developer is getting for the solar panels. And eventually, once you pay them off, you can probably just buy them out for a really low fee and they're yours. And this is a relatively effective model. It does something really interesting again in this diagram because there are all of these components. There is leverage, there's credit being created somewhere by co-investment, and there's leverage being coming in from the state, right? From state money, from the IRS, which is the avoided taxes that allow the private banking system to create leverage for the LLC. So in my book, this looks like banking. There are no deposits being taken because it's all investment. It's all investment banking, but there is banking, and all of these people will have bank accounts somewhere, and that's going to be going through the retail banking system where these bank accounts are cleared. And I'm not including that because that will make this already complicated diagram way too complicated. But again, this is banking, in my opinion. It is part of a network effect that we call banking. Now, what has the IRA done, and why are green banks way more interesting now than they were before? IRA is deploying lots of pots of money that will be operated through green banks as loans. So it's giving you green banks way more government credit to play with and way more credit creation powers. There are three pots of money that I probably listed in the wrong order. The most direct pot of money, one that I am a little concerned about, and we can get into why, is the Greenhouse Gas Reduction Fund. So these are grants that will go to lenders, right? They're capitalized lending funds. They're being dispersed under three programs. One is called Solar for All, which is for direct loans. One is called National Clean Infrastructure Fund, which is for kind of regional green banking collaborations. And the other one is for the National Clean Energy Accelerator, which is going to be a national level nonprofit entity that someone is applying for. That there's going to be some problems with that. I actually was involved in writing some of that language, and I'm not very happy with how the EPA has interpreted that section of the IRA. But the important thing is not only will it be able to create the loans, but ideally, if it's set up right, and if the recipients are set up right, they'll also be buying out the loans on secondary markets. So it'll let you rotate the balance sheet on the bank faster, right? The bank will be able to move it and securitize these things, go away, make them go away, make more loans. There is the loans program office. This is the big pot of money. This is $500 billion. This is a $500 billion investment fund within the Department of Energy that's basically being run as the government's commercial investment bank. It is going to be like 500,000 billion. They want to deploy something like 500 billion over the next 5 years, over a 5-year term. And again, these are loans, so they rotate. So this is not something that will theoretically get exhausted. They have an authority called the Title 17 SEFI carve-out. So traditionally, the Loans Program Office can only make loans to private companies that are using so-called innovative technology, right? So what their goal is to take a technology, let's say geothermal, that's just about needs to be scaled, and get the first units installed, show that they're viable, and then allow them to raise money in the private market. The bipartisan infrastructure law created a carve out to that requirement, saying that if there is a state energy finance institution, which could frankly be anything, it's often a green bank. It could theoretically be the Department of Education if they have some kind of incentive structure for schools. If that if that institution shows meaningful financial support, and that could be a lot of things. The statute is pretty wide open, and the LPO is ready to kind of work with you. They will co-invest with you into this project. They will drop this innovative technology requirement. Um, there are, and the lending they'll do will be at very concessionary rates, especially if you're not a highly rated borrower. There are some issues with this program, like any programs. The first being that this is actually operating a lot like a commercial bank that's being run by the government. So there are upfront due diligence fees and processing fees. So for this to be worth it, you need to find a minimum of $100 million of project finance that you're trying to do here. And if you But what's nice is then you, as a bank, can move from being a bank to being more than a bank and maybe even your own developer, because they would love for you to actually own the asset as a SEFI. There is a third piece of the puzzle here, which are elective pay tax credits. So we talked about tax credit financing before as being something enabled by big banks. Now, after IRA, if you're a public or nonprofit entity, you can actually just go to the IRS and through an application process that's actually quite onerous and say, well, I've invested in this renewable energy project, say, this would be what the total tax credit would look like if I had a tax bill, and the IRS will send you a check back in the amount of that tax bill. If you get all of it right, you can cover as much as 50% of your project costs with that. And what's neat about this is at least 30% of those project costs, there's some of the adders, this doesn't apply to some of the adders that get you up to 50%. Those are uncapped. So for the next 5 years, you can apply for as many of these, you being the entire government and nonprofit sector, as you want, and the IRS will be cutting you checks. Where the green banks come in is a little bit complicated. One problem that we're going to have is that the IRS takes about 5 years for these, 3 to 5 years at the fastest for these to come out, because these come out after the project goes into operation. And because you're not borrowing money from a large bank against a tax credit, you're not going to have the money up front. So you're going to need a source to borrow of capital to borrow from. And that's where state green banks can really be useful. They can issue 3-year loans and then make a small spread on the tax credit and then get repaid. Right. We right now are still getting regulatory. We're basically negotiating with the Treasury as to what these look like. We are trying to, at CP, argue, think correctly, and think we might even get there, that we should just allow green banks to buy up the direct pay tax credits from other nonprofit or governmental entities at their upfront value, and be the entity that applies the IRS to get the money back. And then that's something we call chaining, and that might actually, lower the spreads that the green bank needs to take, and improve the financing more. So that'll make them more of a direct kind of conduit. The other thing we think is that because of tax laws, if you use tax-free, tax-exempt debt, municipal debt in the project structure of this in your capital stack, you're going to get a large penalty, as much as 20% against your credit issuance from the IRS as a government. So it may make more sense to essentially use green banks as pass-through vehicles and fund those loans, maybe with tax-exempt municipal bonds, but fund the projects with loans. It's a kind of legal workaround that might be more worth it now. And again, we're still waiting on rulemaking for some of this from the IRS and Department of Treasury. But what all this means is now you've got a whole lot of tools for various state bank-like entities to begin mobilizing government money, direct real government, high-powered money into the system. I will give you an example of a project that we are trying to design right now with a couple of green banks. I can't mention them yet, but we are essentially working between them and a few federal programs to get this launched. to make this look like a post-IRA, what a green banking program looks like post-IRA, which is a virtual power plant center distributed energy resource deployment program. And this is going to look way more interesting than what the Connecticut Green Bank used to do. This is going to be real government money now. So just for people who don't know what are virtual power plants, VPPs are basically entities which aggregate small amounts, like smaller distributed energy resources together using software. They act as essentially an orchestrating system for your chargers, for your rooftop solar generation, most importantly, your home's battery. When you sign up to a VPP, you basically give them the right to at least control them to some level of control over those systems. And then they will work with your utility or the wholesale grid, and they will essentially sell your storage, your demand as a network, your generation to the wholesale system or the utility scale system at moments in which there's peak demand and low amounts of supply. So they play ideally the same role as a gas peaker does. Without a gas peaking plant would play without the carbon emissions and at ideally a much lower cost because there's not as much expenditure. The way this works is they have an economics, right? They essentially will go ahead and say, okay, we're making these sales to the utility, we're creating savings to the utility, so we're making a profit. So they will split the profit between the VPP itself or the entity that operates the VPP and the members of the network. So you will get like a payment for participating in the network. This is really important. The thing I want to kind of emphasize in the economics here is the largest cost to the virtual power plant is the acquisition cost. It is them going around and finding people with distributed energy resources to sign up to their systems. Marketing, outreach, financing the install sometimes, which we think they should do more, and so does the Loans Program Office. All of this is a huge cost and it's a huge headache. And it takes away from, the incentives that can be given to homeowners. And this will be important in a second. So we've designed a program that we would like to see, that we're looking for a launch that incorporates all these federal financing elements in very compartmentalized ways in order to avoid double dipping regulations. This is just, I'll skip this, but these are, this is the coordination problem of all of these. You need to establish the operator, you need to install the assets, you need to put solar on roofs, you need to put batteries onto parking lots, and then you need to get those assets to talk to the VPP. You need to agree, if a property owner's got to agree to be part of this thing. This is how our scheme works. We would like the Green Bank to be an energy site developer. It provides equity finance to an LLC that holds the properties, the leases to the properties, and it can also raise debt on capital markets to finance these. The Green Bank can use greenhouse gas reduction funding money from the federal government to capitalize this LLC. As a publicly owned LLC, it is eligible to receive public elective pay tax credits and harvest those credits. And because the Green Bank is a much bigger entity than most nonprofits or a homeowner, it's way easier for them to get the full value of the tax credit. It has the staff to fill the forms out. In step 2, Department of Energy's Loan Program Office under the SEFI provision also supports a parallel loan to fund the virtual power plant entity itself, which immediately enters into an agreement with the Green Bank LLC to enroll its energy properties as subscribers to the VPP. What's nice about this is the Department of Energy's LPO has already set the precedent that they will cover the acquisition cost of VPP assets. They will loan to acquire these. In step 3, that LPO loan after the tax credits have been harvested, so we think in about 3 to 5 years, we'll buy out the Green Banks LLC and begin to own those assets directly. If it's a public entity, it might be able to, again, tap into direct pay. We also think that this should be publicly owned because we think the public and regulator will be more comfortable with giving up their rooftop and battery control to a public entity. Then in step 5, the whole process begins again because there is a spread that these are just, how this looks like in diagrams. This is for you guys if you want it. Because the cost of equity of financing this LLC is going to be way lower than its purchase price. So we've got to spread the green banks made, and then they can reinvest the spread into setting up a second LLC and repeat this process. And now you've got credit, and credit is facilitated by real high-powered state money. Now, so just to cover a few things, what can be a green bank, what entity can act to do this credit creation. From the GGRS point of view, it's any public or CDFI lender, ideally the public lender, because the CDFIs often don't have the capacity to do these things very well. From the Loans Program Office point of view, it's any state financing vehicle. So it could be, again, your Department of Education, it could be your Affordable Housing Office, it could be anything that can do meaningful financial support and has a mission to reduce carbon emissions. From the point of elective pay, it's not actually going to a green bank, it's going to a developer. And banks are not always developers, but they can often cross the line, and that would be a good thing. So they would need to actually own the assets. So they can either help with that process or they can just do it themselves and turn it into developers. But again, all of these are sources of public money, which can let you lever and create more credit. And to me, that is banking. So is green banking public banking? Let's get coming back to the big picture. It depends on your definition, assuming that the green bank is a public entity. You could say, yes, it is public banking. It's frankly where I fall. It uses leverage to create loans. It funds itself on capital markets, like through bonding issuance or through other kinds of issuance. It acts as a conduit for public money through effectively a franchise function that's been given to it by IRA now directly instead of indirectly. And it connects to a payment system somewhere, because somewhere there needs to be a bank deposit, and a commercial bank can take care of that. They don't have to make tons of money off of it. You can argue it's not, right? Because it does not create credit directly. It does not create credit through payments. It does not handle consumer deposits. And it has a limited remit of lending just to carbon mitigation projects. So it's not a full balance sheet. I, however, think it is banking, because I think banking is a wide thing. It's not just deposit creation. I think investment banks and shadow banks are banks, and they network with other kinds of banks. Most importantly, I think it kind of opens a box. It gives you an advocacy opportunity, right? Because somewhere in all of this, and I'll go through this with, the Loans Programs Office and how they issue loans, you begin to have a real conversation about where money in the payment system comes from and the role of the state in it. Because frankly, all of this is accounting tricks, right? How does the LPO issue a loan or a loan guarantee? We'll just assume we're talking loans. You give it an application, they approve it, they go to the Federal Financing Bank, which is a bank, quote unquote, that exists within the government to finance agency programs. And it says, hey, Federal Financing Bank, will you give a loan to our borrower? We are going to guarantee this loan out of the Department of Energy budget that we have, so that you don't make a loss. The Federal Financing Bank, how does it issue money? Well, it takes basically an interest-free loan. It might be a little more complicated than that in practice. I'm still trying to figure out the statute from the Treasury, which it is a part of, and issues the loan, then goes to the Treasury issues a payment to the borrower, out of the Treasury General Account, which is a account the Treasury holds at the Federal Reserve. It's the only entity that can hold, cash like payment accounts at the Fed. And it gives money, it transfers money to the bank account to the borrower's bank. And then the borrower repays the loan back into the Treasury General Account, which transfers it to the Federal Financing Bank, which then repays the Treasury for the loan back into the Treasury General Account. All of this is a lot of financial, is a lot of kind of government bookkeeping to go for the fact that the government is creating means of payments and it's injecting them to private actors out of its own cash making system. The question I would ask is, if we are interested in now creating parallel payment system or a parallel savings system, even because I think there should be public savings instruments. I think I can talk about those separately, but I think they have really useful applications for monetary policy and rate policy if the government essentially gives you a retirement account that ideally converts into an annuity after some period. You can put in as much as you want in the account. I can get into that. There's actually like really interesting, very liberal, I'd say like free market thinking, relatively research on why that works really well compared to the IRA system and compared to your 401k system. Maybe we should do that too. And maybe we should have access to the Federal Reserve's balance sheet one way or another more directly. So again, from an advocacy point of view for, payments and savings accounts and retail, this does open up a box. And I think that's important. So I'll leave it at that. And I think I would love to take questions.
Yeah, great, great. So I want to thank you for that very informative,
We
very detailed
gone very long, but
presentation.
I can stay over. I'm sorry. I thought
Yeah,
we had time.
no, it's okay. We're doing fine. We already have a few questions in the chat. I'm going to ask everyone, if you have a question, just use the raise hand feature and I'll call on you from the order that I see them, okay? And it looks like Phil is really has already jumping the gun and he has several questions in chat. So Phil, I'm going to hand it off to you.
I'm in a
Phil?
noisy place, so I hope you can hear me. Tom, maybe you can just.
Yeah, I can
Yeah.
just see. Let me see if I can pull the chat open. I can look.
Why don't you stop sharing your screen?
Yeah. Good 1 second. Sorry, I'm speaking out of a very small
Here, I'll
room.
stop it for you.
Thank you.
And then you should be
Yeah.
able to bring
So
up the
let me.
chat.
Yeah, I should be. Give me 2 seconds. Sorry, I am.
I can also read the question if you
Yeah,
have.
no, I
So
have it here.
Phil's
Don't.
first question is, so will the public bank's charter be limited to loaning to nonprofit developers serving LMI customers?
Um, it doesn't have to be It depends on, so if it doesn't have to, you can kind of set the charter however you want. The GGRF, if you're using greenhouse gas reduction fund money, so the federal grant to set up the program, then yes, it is going to be targeted toward those communities. But if you can find other sources of startup capital, which you should, sky's the limit here.
And then he,
Um, when the
as a,
I
fo-
our
oh,
subsidy
sorry.
and
Yeah.
so we've got about depending on which subsidies it is, we've got about 5 years to really like get these things running. 10 years on some of the others. So 5 to 10 years.
And Phil, I see your question about Washingtonians for public banking. I'll answer that, but I want to get through a few other questions specific to this presentation. So, Vicky, I see your hand up. You want to go ahead?
Um, yes, I thank you. Thank you for the presentation. I was just wondering who would oversee the green banking setup, and also my question is, how would this benefit people who are seeking, say, co-op housing? Um, would that help in that regard?
So in terms of overseeing it, there are a couple of models that we've seen nationwide. With in Washington, like just before I came on, I looked through my database of possible green-like entities. There is a green bank-ish entity in Washington State in the Department of Commerce, for example, that's just run out of the department as a grants program. Though seems to be flirting with being converted into a full-scale loans program, right? So there are agencies that can do this. There, depending on your state law, there are, utility districts that can do some of this work that can kind of be your initial starting point. In the case of a full-scale, green bank that is its own instrumentality, usually you have kind of a state-appointed board. Someone's appointed from the governor's office, someone is appointed from the legislature. Sometimes there's usually union representation, some community representation on the board, depending on how you set it up. And then that board elects, hires a CEO, which then, that person does the work of hiring the staff and hiring the rest of the organization and responds to the board. So they look like they're basically state-owned corporations, right, with specific powers. For co-op housing, we at LPO, we are definitely not LPO. We talk a lot about them, but we are not the LPO. The LPO would not be happy with me accidentally saying that. We at CPE have a housing program. We do think, if you want to use some of these resources as a public that wants to set up this bank towards co-op housing, I think you should. And I think, frankly, there is room to interpret the greenhouse gas reduction fund as, enabling that if there are greenhouse gas reductions in the capital investment. There is room to advocate, say, to the loans program office to co-lend into something like that. Again, if you can prove the greenhouse gas reductions, and meet the meaningful support statements, especially if you're, doing something really interesting like making this co-op housing program use reclaimed recycled wood or mass timber or prefabricated housing. They will be, I believe, really interested in entering a deal like this under the CEFI program. We at CPE are big fans of what Montgomery County, Maryland does. In fact, our housing director and executive director, and one is now talking to, probably as we speak, presenting, or have just finished presenting to HUD as to what they do in Montgomery County, in which they basically, have a green bank within their housing department, or a bank-like entity within their housing department that uses leverage to enter deals with private developers to build housing, and then eventually buys those private developers out, again, using leverage, and owns the housing at 100% equity. And it uses market rate units within those buildings and use the profits from those market rate units to subsidize below market rate units. And it's become one of the county's largest real estate developers. That is a for-profit company, basically, that uses profits to subsidize affordable housing. It's a very effective model, and we actually, the White House has actually endorsed it now in the next budget, and as something that they might want to issue federal funds towards incentivizing these kind of programs on local level. So we'll see where that goes. So yeah, you can do all kinds of stuff with this, right? The question is, this is not completely non-market entity. There are, limits to, you're not printing money. You're not a bank. You're not the Fed. You can't print money. You're not the Treasury, but you can extend money, and, that's useful. You can think about all kinds of ways to deploy that money. You just got to make sure the streams align, and as a public entity, you can do that.
Great. Do we have any other questions? I'm not seeing any hands go up. I do want to address the other question that Phil had in the chat just about what's happening here and Washington and Washingtonians for public banking. Um, uh, so Yakko is right that the Department of Commerce in the state, it does have is trying to get a green bank offering lending off the ground. I've actually had some conversations with some people, with one person in the Department of Commerce. Um, it's not going to be sort of the public bank the way that we think of it as in North Dakota, where the government takes in its revenue and then puts it in a deposit, lends against that. But it will hopefully get off the ground so they can use some of the IRA features to fund green energy projects in the state. There was a public banking bill that was introduced not this session, but the session previously. It was reintroduced this session, but it didn't go anywhere. It ended up dying in committee. And that was a public infrastructure bill. So it was created basically a cooperative among the state's local municipal, county, and tribal governments, where the institution that they created would lend to them for infrastructure projects. But it was basically a government to government cooperative institution that acted as a bank. Uh, like I said, that bill has died. Uh, Washingtonians for Public Banking is in conversations with a lawyer and some other experts to draft our own legislation that we hope that would create a really robust public banking model for the state. But we're still in the process of drafting that. But hopefully we will be able to introduce that to our legislative allies and to the public soon, so that we can move forward in our campaign to promote public banking here with a very strong and clear direction. So I hope that answers your question, Phil. Okay, so we are at time for this presentation. Do we have any final questions or comments? Not hearing any, I want to thank our speaker again, Yakov. Like I said, it was very informative and a very detailed presentation. Just one more time, this is part of Washington's Public Banking's virtual town hall series, which we do every 2 months. So please check our website and our events page where we will have our next one up shortly.
Thank you very much.
Yeah, thank you everyone for coming. And remember to visit us at www.waforpublicbanking.org.
All right, thanks.
Mhm.
Thank you.